Hello, this is Liz Brown with Richland College. Today we're discussing our equity chapter. Please be sure to do the readings and look for any other resources available on eCampus. If you have any questions, please let me know on the discussion board. There are a lot of new words and definitions that we're seeing in this chapter. I'm going to cover a few of these and then do an example. We talk about the differences between public and private corporations. Public corporations allow public investments. These are a lot of the large companies, McDonald's, Burger King, Target, Walmart. You can go out and buy stocks yourselves in these companies. There are more stockholders and more options for stock purchasing because you can go out to E-Trade or any other source and buy these stocks. It is regulated by the SEC. That is the Securities and Exchange Commission. Private corporations have no public investments. They can still have stockholders, but these stockholders are, for example, family members or a smaller pool of investors. They are not regulated by the Securities and Exchange Commission. However, most of these companies do follow those rules in case they choose to go public. They could go public with an IPO, an initial public offering. Here are some of the advantages and disadvantages of being a corporation. Limited liability. A stockholder can lose no more than the amount invested. If you invest $10 in a stock in a public company, if the company goes out of business, you only lose that $10. People cannot come after your personal cars, homes, etc. The ability to raise capital. Attracting outside investment and transferring ownership is easier for these corporations. They're able to go out and sell stock on the open market. Disadvantages. Double taxation. So you get taxed twice. The company gets taxed, as we saw in our multi-step income statement, and when investors get dividends, you are taxed as well. And I like to think of this more as an advantage for us as accountants, but more paperwork. Federal and state governments impose additional reporting requirements, but that means accounting jobs. Now let's talk about how we can raise funds for our companies. Assets equal liabilities plus stockholders' equity, the basic accounting equation. If we want our assets or our resources to increase, for example, additional cash, we need to increase either our liabilities, what we owe to a bank or bondholders, or our stockholders' equity, which is a focus on this chapter. Let's go ahead and compare some of these options. Here we have common stocks and preferred stocks. These are under equity. And here we have bonds, which is a common way of financing with a liability. Voting rights. Common stocks do have voting rights. They are the owners of the company. If you own 1 or 2 stocks, maybe you can't make a difference. But if you own 5%, 10%, 50% of the stocks, you are in control of the company. Preferred stocks usually do not, and bonds are a liability. They are not owners. They're in this section. They do not have a right to vote. The highest risk to an investor is common stock. The lowest is bonds. Bonds are a liability. If a company goes out of business and files bankruptcy, bonds take the highest preference because they are a liability, whereas equity, especially common stock, has the biggest risk and most likely will lose everything in their investment. You can see this down here with preference for dividends and interest and preference in distribution of assets. The highest goes to the bonds. Those are liabilities. Same thing for interest. If a company doesn't have much money, they're going to pay their bond interest, which is a liability, before they're going to pay dividends. But as you can see, with the highest risk is the highest reward. If a company is successful, the common stockholders are going to get the biggest return. Also, tax deductibility of payments down here at the bottom. What you're seeing here is that bonds, yes, that is interest expense that we pay, and interest expense is tax deductible, which is a benefit for the company. With common stock, there is no such thing as a dividend expense. Dividends are not tax deductible. I hope this chart is helpful to help you understand the differences between common stock, preferred stock, and bonds.